What's going on, everybody? It's the Wise Investor here, and today I'm going to be explaining the difference between the two main investment strategies, which are income investing and growth investing. So, this is an article I pulled up on lloydsbank.com, and we're just going to run through it here. So, the two most common investment approaches are income investing and growth investing. Now, what is the main difference? Income investing is when you're focusing on generating income from your portfolio. You're looking to get regular, predictable dividends or distributions into your account every month or every quarter or every year. Whereas growth investing is where you're looking to accumulate growth over a longer period of time, and you're looking to benefit from capital appreciation and compounding over a longer time frame. So, income investors aim to create reliable, steady cash flow by collecting regular payments of dividends from shares, income from funds and ETFs, or interest from bonds. In this way, their investments act like a second job, paying them in intervals throughout the year. Growth investors aim to increase their overall capital value of their portfolio by reinvesting the income earned from their investments to maximize growth. The reinvested income could buy more of the shares, funds, or ETFs, which will potentially grow in value too. In simple terms, your returns are also earned returns, a benefit known as compounding. Which is most suitable for me? So, when determining whether you want to focus on income investing or growth investing, it's really dependent on your personal objectives and your personal goals and where you are at in life at the moment. Things like your age, your employment status, your income, things like that will all need to be taken into consideration when you're deciding which strategy is best for you. The decision whether to reinvest income or not will depend on your personal circumstances and your specific investment goals. Key things to consider are your investment horizon. So, your investment horizon is basically going to be how long you have from right now until the time where you're looking to reap the benefits of your portfolio, right? So, if you're older, you'll have a shorter investment horizon. If you're younger, you'll have a longer investment horizon. Income investing could provide benefits sooner. Growth investors often need a long term view to benefit from the compounding. So, when you're income investing, you're generally going to start to see your returns right away. In the first month or the first quarter or the first year, you're going to start to get your payouts. Whereas growth investors, you're not going to get anything out of your portfolio until, the near future or the longer future. Uh, Risk tolerance. High growth assets may involve higher risk compared to established dividend paying assets. So generally, when you're more focused on growth, you're taking a little bit more risk. And when you're more focused on income, you're taking a slightly lower risk. But often, when you're focused on growth, you're going to get better returns overall than the people who are focusing on income. But really, it's dependent on your objectives. Employment status. Income investing could be particularly useful if you're in retirement or looking to shift away from full time employment. So, this is a big factor when deciding whether to focus on growth or investing or income investing. Now, somebody who's a growth investor is generally not looking to capitalize on their investments until later on in life at retirement. These are usually, a younger person earlier on in their career who's starting to find out about investing, and they're looking to build something up until they're older and they're ready to retire. Whereas income investors are generally looking to replace or supplement their income. So typically, most people who focus on income investing are usually older people, people who are getting ready for retirement. But it could also be useful for younger people who are looking to retire early, or if you have some kind of specific objectives, and especially with the current climate of how expensive the cost of living is getting, it's starting to make a lot more sense to be focused more on supplementing your income and maybe decreasing some of your expenses or maybe covering all of your expenses as opposed to just focusing on long-term growth in the future. And age is going to be another big factor. Growth investing may appeal to younger individuals at the start of their investing journey who are looking to build wealth for their long-term life goals. So generally, when it's growth, you're in it for the long haul. When it's income, you're looking to kind of get the benefits right away. Now we'll talk about what kind of investment vehicles you could use for each strategy. So, for income focused investors, you could buy shares. You may consider investing in established cash generating companies with a strong reputation of paying significant dividends to shareholders. These will be your companies like Enbridge, these will be your companies like Agnico Eagle, the companies that are in these industries where they're not reinvesting all of their profits. They're taking a big chunk of the money they're making and they're distributing it to investors, and they have a history of dividend growth each year. They're paying out more and more dividends. You could also invest in funds and ETFs with an income label, which indicates that your portion of income earned in the fund will be paid out in a regular interval. So this would mean an asset manager is going to build up a portfolio that's going to generate income, and they're going to distribute that income to the shareholders annually. When a company pays a portion of the profits to shareholders, it's called a dividend. When an asset manager pays a portion of the profits to a shareholder, it's called a distribution. I might use these words interchangeably sometimes, but they are two different things. Companies pay dividends, ETFs and funds pay distributions. And then you have investment trusts, things like REITs, where they might own a portfolio of rental properties and all of the proceeds that are made are distributed. And then you have things like bonds, things like GICs. These are things where, fixed income investments where you're putting your money in and you're going to get a lot lower return, but it's kind of the lowest risk investment you could get. It's the closest thing you could get to guaranteed money, but you're looking at returns like 2%, 3%. For growth investors, you may consider investing in companies that reinvest profits back into the business rather than paying dividends to boost your growth. Small cap stocks often fall under this category as the businesses are trying to grow and expand. So, growth focused investors are looking for things like tech companies, new industries, semiconductors, things they're looking for the future and they're looking, to get in early so that they could capitalize on those big, 10x, 20x, 100x returns that you see from companies like Nvidia and whatnot. Funds with an accumulation label indicate that your portion of income earned from the fund automatically reinvested into the fund. So in this case, you're investing in a fund that instead of paying out a portion of the profits is going to be reinvesting the profits to grow capital or for capital appreciation. ETFs focusing on growth sectors and emerging markets. So these are industries like biotech, tech, things that are more geared towards growth. So generally, a growth investor is someone who's going to be looking have a longer time frame You're looking for bigger returns, you're looking for capital appreciation, but you're not looking to get any benefit out of your portfolio in the near future. Whereas an income investor is looking to generate steady, consistent income to supplement or offset their expenses. So that's there's a big trend going on. Fire, financial independence, retire early. So in this case, a lot of younger people like myself are starting to focus more on income investing as opposed to growth investing, because it's a very specific goal of trying to retire early and trying to replace your income. So things for people to consider. I personally use covered call ETFs, with which give you a little bit of both. They kind of more lean towards the income side, but basically how those work is they'll hold assets and they'll sell call options against those assets, which basically means they're selling a contract stating that if the stock rises to a certain price, then they will sell the shares at that agreed upon price, and whoever buys the contract will be paying a premium, and essentially they'll be collecting all these premiums and paying them out as distributions to shareholders. So in this way, you get the income aspect, but you also get exposure to the underlying asset by the ETF holding that asset. So if you have a S&P 500 covered call ETF, you're getting the benefit of selling contracts against that index and collecting premiums, and then you're also getting exposure to the S&P 500. The main difference is that you're going to be giving up some of your upside, because whenever you're in a bull market, you're going to end up the ETF is going to end up having to sell a lot of its shares. So you're not going to get the full upside potential in the bull markets, but in a down market, you're going to be collecting a lot of premiums. So in the bull market, you're not going to perform as good as the growth investor, but in a bear market, you're going to be a lot better off than the growth investor. So, that's my little rundown on the difference between growth investing and income investing. You could assess your own situation, your own goals, and, basically look at what you think would work best for you. So, thanks for watching, and I'll hit you in the next video with some more free game.